If you're a contractor, you've probably heard about surety bonds and insurance, but do you know the difference? More importantly, do you know when you need a bond versus when insurance is enough? Making the wrong move here could mean losing out on big projects or even breaking the law. In today's video, I'll explain why contractors need surety bonds, how to qualify for a bond with little to no experience, and when you need a bond versus when insurance alone is enough. So let's get into it. Before we dive in, make sure to hit that like button and subscribe to the One Exam Prep channel for no BS advice that helps you grow and protect your business. This video is brought to you by One Exam Prep's sister company, One Insurance Solutions. One Insurance specializes in working with the construction industry throughout the United States, helping contractors navigate general liability, workers' compensation, builder's risk, life insurance, and anything else to help protect your construction business. All right, first things first, let's break down the difference between a surety bond and insurance. Even though they're both types of financial protection, they serve very different purposes. A surety bond is a guarantee. It acts as a promise that you'll complete a project according to contract terms. If you fail to deliver, the surety company pays the client, but you have to pay them back. Common in government and commercial projects. Insurance, on the other hand, is risk protection. It covers accidents, injuries, or property damage related to your work. You pay a premium, and the insurance company absorbs the risk. You don't have to pay them back, and it's required for general business protection. So if a client wants a surety bond, they're not just checking if you have coverage, they're making sure you can actually fulfill your contract obligations. So why do contractors need surety bonds? Well, in many cases, you can't even bid on certain projects without one. So when do you need a surety bond? Typically, public works and government contracts, many federal, state, and municipal jobs require bonds. Large private projects, developers and GCs may require bonds to ensure project completion. Licensing and compliance, some states require contractor license bonds to legally operate. And protecting your reputation, a bond shows clients you're a serious, financially stable business. If you plan to bid on big contracts, especially government or commercial jobs, you'll probably need a surety bond. It's not just a formality, it's a sign of trust that you can handle the job. Now, if you're new to the game, you might be wondering, how do I qualify for a surety bond if I don't have a long track record? Here's what bonding companies look at and how to improve your chances of approval. So what do they look at? Number one, credit score. A strong personal and business credit score helps. Financial statements. They'll want to see cash flow and assets. Work experience. Any prior construction experience is a plus. And business plan and references shows you're serious and reliable. If you're new, here's how to boost your chances of qualifying. So work on small projects first. Build up your experience with smaller non-bonded jobs. Improve your credit score, pay off debts, and make sure your credit is solid. Partner with experienced GCs. Some bonding companies are more flexible if you have a mentor or partner with a strong history. And use a bonding assistance program. Some government agencies offer programs to help contractors get their first bond. If you're struggling to qualify, talk to a bonding agent. They can guide you on what to fix or how to improve your chances. All right, let's answer a key question. When do you need a surety bond and when is insurance alone enough? You need a surety bond when bidding on government jobs or large commercial projects, state licensing requires it, or a client specifically requested in a contract. And when is insurance enough? If you're working on small residential or local projects, you only need coverage for accidents, injuries, or property damage, or you're just starting out and not bidding on bonded work yet. If you're mainly doing small remodels or subcontracting under a GC, you may not need a bond right away. But as your business grows, getting bonded opens doors to bigger projects and higher paying jobs. All right, now you know the key differences between surety bonds and insurance, when you needed a bond, and how to qualify even if you're just starting out. If this video helped you, just hit the like button and drop a comment below. Have you ever needed a surety bond for a project? What was your experience? Let's talk about it. Subscribe for more contractor business tips, and if you need help setting up your business the right way, check out the links in the description. See you in the next video. Keep building smarter. And for more information about One Insurance Solutions, you can call them at 1-877-700-0243, email them at sales@oneinsurancesolutions.com, or visit them at oneinsurancesolutions.com.